It didn't have a retail or commercial arm, but many investment banks did, and this meant trouble for you and I. For banks that had both a retail and investment arm, if the investment banking arm of a bank could not stump up the cash when things went wrong, the creditor, who they owed money to, had the right to take cash deposits sitting in the retail arm of the bank to pay for the investment bank's mistake. This was the money you and I deposited into so-called safe banks. The money we were saving for our first car, our holiday, our first home, or even our retirement. Now, if events were left to take their natural course, we would see what's called a run on a bank, whereby depositors queue, waiting to withdraw their money from the ailing bank before it collapses and they lose it all. This is what happened with Northern Rock, and why the UK government had to step in, and why it did the same for Lloyds TSB and HBOS, which have now merged, and for the Royal Bank of Scotland. So the government decided to step in and save the day. Well, not really. Governments all over the world, including the US and UK, bailed out these ailing banks. They basically paid out the bad debt for the banks in exchange for equity. They bought into bad banks, and now the government, the citizens of these countries, own them. The bailout amounts promised around the world topped $8 trillion. In fact, the US alone promised about $1 trillion. The UK's promised £350 billion at last count, but that's still rising. Now, on the face of it, the governments of the world look like they saved the day, but what they effectively did was steal from us, the people. Where did the money for the bailouts come from? It was created out of thin air by the central banks of the world, such as the US Federal Reserve and the Bank of England. These central banks created the money out of thin air and lent it. Not gave it to their governments, but lent it with interest. So, how are the governments of the world expected to pay the huge amounts of interest? By paying it with our taxes. Yes, more and more of what the government takes from us in taxes to pay for schools, hospitals, roads, and other vital services is going to pay for abstract debt, created out of thin air by a small group of people who then reap the rewards of interest on that debt. How much of our taxes are being spent on servicing our ever-growing debt? Well, at the end of 2007, general government debt was around £618 billion. By mid-2008, it was about £635 billion, and by the end of 2008, it was £750 billion. The interest on this amount equated to about 5.4% of public spending in 2008. The UK Office of National Statistics expects this value to potentially rise and sit somewhere between 1.5 and 2.2 trillion pounds before the crunch is over. That's roughly 2 to 3 times the size it was at the end of 2008, and almost 4 times the amount of debt the UK was in at the end of 2007. In 2008 terms, we're looking at 11 to 15% of national spend going towards paying the interest on this debt. Not even paying the debt back, just paying the interest. To put that in perspective, 15.5% of public spend goes towards the NHS, 7% towards schools, and 3% towards transport. The government at the end of 2008 spent more money financing debt than investing in schools, and the UK Office of National Statistics thinks this figure is going to get so big that the government will be spending as much money paying interest as it will spend keeping the National Health Service going. Please remember, we're simply talking about paying interest here, not even paying back the debt itself. Now, just when you thought they couldn't screw you anymore, let me introduce you to quantitative easing. Quantitative easing can be explained in very simple terms. The government wants more money in the system. It gives its central bank a promise to pay it back a certain amount, let's say £50 billion. The central bank accepts this promise and creates the required amount of money out of thin air. The money is then given to the government. The government then lends this money on to retail banks, commercial banks, and so on, with the expectation that the banks will lend the money to the private sector. That is, to businesses or people like you and I. Hopefully by now I don't have to remind you that this money is being lent with interest. Quantitative easing screws over the citizens of a nation in 2 ways. Firstly, it promotes more debt to be undertaken by the general public. This new money is not given to the people, it's lent with interest charged. Secondly, It's a backhanded way of stealing the money you already have by taking away its buying power. For example, let's say that the total money in circulation is £1,000, with 10 citizens having £100 each. Each citizen has 10% of the total money available and 10% of the buying power available. All of a sudden, the government injects another £100 into the money pool by giving it to a bank to lend to the public. The bank lends at its discretion. It does as it pleases and lends to who it wants, assuming it even lends the money rather than just hoarding it. And if it does decide to lend this magical money, it will charge interest. Now, 2 of these 10 citizens are lent £50 of this magic money each. Through no fault or action of their own, the other 8 citizens now have only 9% of the money pool and subsequent buying power, whilst the 2 citizens that were lent the money now have 13.6% of the money pool and buying power. This kind of activity is also what causes inflation, and if done too aggressively, causes hyperinflation. 8 citizens, through no fault or action of their own, have been robbed of 1% of their buying power, and the other 2 have created more by going into debt. So, just to summarize, investment bankers gambled with other people's money for years, reaping the rewards of excess and leaving the rest of society in their wake. They not only risked their money on even more exotic and risky gambles, but our cash as well, deposited in so-called safe banks. The government turned a blind eye to this because times were good, and when things fell apart, gave them as much cash as they needed to stay afloat. Cash which the public now has to pay for with ridiculous amounts of interest. Interest which will cost us as much as we pay for the NHS. And if you didn't think the bank screwed you enough by gambling with your money, or the government by taking out a loan in your name, a bit more of this magic money was created from thin air via quantitative easing, so that whatever money you still had was worth less than it was. Welcome to 21st century banking.